The Relative Strength Index, the RSI, developed by J. Wells Wilder, is an oscillator that measures the speed and change of price movements. It functions as a technical indicator to support successful trading. The RSI moves on a scale of 0 to 100. Traditionally, the RSI is considered overbought when it's over 70 and oversold when it's below 30. The RSI can also be used to identify the general trend and when an asset is significantly overbought or oversold. Here's a simple example. You can see on this chart how the oversold conditions on the RSI below 30 line up with reversals in the price action. As an example, previously we're in a downtrend here. The RSI becomes oversold, it goes below 30, and then the price action reverses. Again, after a brief sell-off, the RSI becomes oversold again, and the price action reverses, and this continues. The RSI is a great tool to use to supplement your existing trading strategy. As an example, if I was watching this downtrend and looking for a potential reversal in the price action, this trend line might be something I'm looking at. But as the price action reaches here, that might not be enough to convince me to enter. However, if the RSI, as it is, becomes oversold when it reaches this trend line, those two things combined might give me the confidence to buy here. And if I had, I would have had profits. Why is the RSI important? Traders can use the RSI to predict the price behavior of an asset. It can help traders validate trends and trend reversals. It can also point to overbought and oversold states in the price action. It can provide short-term traders with buy and sell signals. The RSI indicator uses the price of an asset as the basis for its calculations. But the Stochastic RSI, a separate but similar indicator, uses the RSI itself as the primary data source, providing a slightly different perspective on any given asset's price action, with the Stochastic RSI being more focused on shorter-term trend changes rather than the longer-term oversold and overbought conditions that the classic RSI aims to highlight. So now let's take a look at the Stoch RSI. The Stoch RSI or Stochastic RSI was developed by Tusha Chande and Stanley Kroll, and like the original RSI, the Stoch RSI also moves within a range of 0 to 100. But unlike its predecessor, the Stoch RSI reaches these levels much more frequently, resulting in an indicator that offers more potential trading opportunities. As you can see here, the Stoch RSI's movements line up almost perfectly with the trend changes in the price action, meaning it's very good to spot trend changes on a macro level. So the benefits of the Stoch RSI over the traditional RSI: it's better suited to short-term trades, it works better for range trading, and can spot trend changes when the RSI falls short. So what do I mean by that? As an example, when the traditional RSI is stuck as neither oversold or overbought and stays within the 30 to 70 range, because traders are typically waiting for oversold or overbought conditions to enter a trade, if these overbought conditions or oversold conditions never happen, traders are left waiting. Likewise, when the RSI is stuck ranging in an overbought state above 70, the Stoch RSI, being more sensitive and more consistently moving between its points of extreme, can make up for the classic RSI's lack of helpful signals at certain times. Because of this, the RSI and Stoch RSI are best used together, which is why you will often see many traders with these two indicators open and active at all times. Let's now take a look at how we can use these two indicators to inform your trading. So this is SOL. We were previously looking at this token to discuss continuation patterns in the price action, where we'd wait for the price to come up, enter a continuation pattern, would then buy the breakout, benefit from the move upwards, and then rinse and repeat all the way up. One thing I didn't discuss in that video was, how do you know when to take profits on the way up? How do you know? Obviously, you should have trend lines all mapped out on this chart based on previous price action. But if you didn't and you don't, the RSI can help you out. So the price action comes up and the RSI enters an oversold state in conjunction with the Stoch RSI, and then price sells off. So if we were to buy in here following the breakout of this continuation pattern, we would be looking for the RSI to tell us when to sell. So the price comes up and look, we enter an oversold state on the RSI and the Stoch RSI, and the price action recedes. We then do it again, we buy the breakout, and then once the price action reaches the top of the RSI or an oversold state, we then sell. And then we rinse and repeat. And you can see this strategy works quite well all the way up. This is just an example of how you can use the RSI in a basic way. Now, in this case, the RSI and the Stoch RSI are working pretty well in lockstep, but on different time frames and under different circumstances, they may diverge slightly. And then you might switch to using the Stoch RSI more than the traditional RSI, or vice versa. There's many more things to cover about these oscillators, these indicators, but right now I just wanted to highlight the basics of how you can use them. Typically, you should not be using these indicators as the only means of assessing when to enter or exit a trade, but instead using them in combination with continuation patterns, trend lines, etc. But there will be more to come on these indicators. Which point on the RSI would give you the confidence to buy? The answer is A. A represents an oversold state on the RSI, and in conjunction with other indications would be a great place to jump in to a trade. In the next video, we will take a closer look at how to successfully buy the retest when price action flips a trend line from resistance to support. A strategy frequently referenced on this channel, and it's a fundamental component of another strategy we recently covered called buy the breakout. So stay tuned for that. Until then.